We're going to talk about credit spreads, in particular, a bull put spread. We got this theme working right now on credit spreads. I've got a YouTube webinar coming up next Monday evening on credit spreads. So I want to get in the mode. I want to give you a little microcosm, a shortened introduction to something we'll talk more about next Monday night, I believe. I'm going to focus on the bull put spread, and in introducing this, if I had a smaller account, this would be the strategy I would use the most. I'm not saying it's my favorite strategy. It would be if I was just getting started. The naked put's my favorite strategy, but this is definitely the naked put alternative when you have a smaller account. It gets you cash flow. It gets you high probability. It gets you more consistency, which are a lot of things that check my boxes. So brief intro here to the credit spread. We're going to do one of these on Tesla. So I'm going to build a bull put spread on Tesla, but let me set the table first. Reason I like these, okay? Number one, higher probability of profit. When you think about what you're trying to accomplish as a trader, you want to make money, but not like randomly. I'd like it to be somewhat consistent and reliable. So any strategy or tactic I can use to increase the consistency, my confidence that money's going to come in the doors, is something I'm going to seek after. And a bull put spread has that in spades. As part of the higher probability, like one of the reasons why it has a higher probability is you profit from time decay. You profit from the passage of time, something that's more predictable, something that's more reliable than guessing if the market's going to go up or down tomorrow. You get a profit from the overpricing of options. One of the analogies I like when you're selling options, you're like an insurance company. Why do insurance companies make money? Well, they make money because they price the policies such that they have built-in profit margin. They know they're overpriced, right? And they've systematized that. It's the same thing as a casino with games on a casino floor. The edge is in the house's in the house's favor, and so the more people that play the games, the more money they make. I want to be a casino. I want to be an insurance company. I want to be engaged in a business model where the edge is in my favor, and they're built-in profit margins from the wares that I sell, so to speak. You tap into that a little bit when you're selling options, in particular puts, and so it benefits bull put spreads. I'm going to say it's easier to find trades as well. It's easier to find trades when you're doing things like credit spreads and bull puts because you've got a bigger margin of error, and there's less of a chance that you're just going to get whipped out of these as say if you were doing a long stock trade, for instance. So those are some of the perks, some of the reasons why I really like the strategy. The structure for this, it's pretty simple. All we're doing is we are selling out of the money puts that we hope expire worthless. Right, we are betting the market will not fall too far, and that's like worst case. I mean, best case, this market goes up. It's a bullish trade. If it goes up, we're good. If it goes sideways, we're good. If it goes down a little bit, we're good. We just don't want it to go down too far, which speaks to the wider range of outcomes that still yield a profit, right? The higher probability. But conceptually, you want the stock to go up, so you're looking for situations here where you're bullish, right? You got an uptrend or whatever. We're going to look at Tesla in a second. Tesla's in an uptrend, right? But Tesla's also volatile, and so I want to go bullish, but I want a high probability of profit, and a bull put spread gives me that, right? So you're going to be selling puts that are below the current price. Generally, we sell like 1 month, maybe 1 to 2 months. Some people will sell shorter term. That's fine. It's more aggressive. If you sell 1 week bull puts or 1 week naked puts, you got the potential for more profit. But if you're wrong, you get hit a little harder, right? And then I'm going to sell usually a delta around 20 or less, delta of 20 or less. Opinions vary on that, but the idea here is if you sell a delta with a 20 or less number, then your probability of winning is greater than 80%. And so the delta directly reflects your likelihood of success, your probability of profit. If you want to structure these with a good chance of winning, you want to sell lower deltas. So delta 20 or less. And then I like the ROI to be around 10% or more. You start to learn that you can't pick up pennies in front of steamrollers. Eventually, you just lose all your pennies because you die and you get rolled over, okay? You got to make enough money on your average winner to offset the inevitable losers that will come your way. And if you skew these high probability trades too far, where you have a 99% chance of winning, but you're making pennies, then that 1% of the time when you're wrong, you're going to get back all your pennies and then some. So for a credit spread like this, a 10% return is kind of the minimum that I'm willing to accept. If I can get more, great, but I'm not usually going to do a bull put for a 2% return or 3% because I think I'll give back all my gains and the occasional loser. So that's what that means is if you do like a $5 wide spread, you want 50 cents. If I do a $10 wide spread, I want at least about a buck. So it translates into about a tenth of the spread width. Okay. Now, what am I talking about with spread width? Well, you sell an out of the money put and then you buy a further out of the money put. So if I sell a 90 put, I'm going to buy an 85 put. That would be a $5 wide spread where I'm just buying a strike that's $5 below the one that I sold. Right? Okay. Well, like I said, you're getting the shortened version. That's probably good enough on the intro. Let me go build one on Tesla and show you what I'm talking about. So if I go to Tesla, Tesla's been very well behaved this year. It's as if somebody flipped the switch because this looked horrific, by the way, coming into 2023. It's like it could not find a buyer. Nobody wanted Tesla. It went down like every day in December, right? And then for whatever reason, new calendar year, new you, all right, new you, and Tesla's like, I'm going to do better this year. And we've hardly seen a down day. It's like gone in the exact opposite direction. It's been very impressive. 3-bar pullback. I bought at the 9 last week. Yesterday was a good trigger day on Tesla on this little bull flag here. So let's assume you want to be leaning bullish in Tesla, but you want the high probability, you want all the advantages I just talked about. So instead of buying the stock, instead of buying a call, instead of buying a bull call spread, you're going to sell some puts. And you're going to do a bull put spread in particular. And one reason why you might do a bull put instead of, say, just selling a naked put is because the stock price is expensive. That's another thing I didn't really mention is the collateral or the cost of a bull put is quite a bit less on expensive stocks than a naked put. So you may do it of necessity. Maybe you wanted to do the naked put, but you ran the numbers. And you're like, this costs too much money. I need a lower cost alternative. I'll do a bull put spread instead. So essentially, stocks at 212. I'm going to sell a 1 month out of the money bull put. And I'm going to go as far down as I can to get as wide a range of profit as possible while still getting that 10% return. Okay, so I'm going to go to the trade tab. Got a lot of weeklies and everything, but I'm just jumping to the 1 month, 30-day. And I like to use the delta column to kind of guide me. So here's the first delta below 20, the 180 strike. But remember, that's kind of the 20 delta or lower. Listen, if I can sell a 15 delta or a 10 delta and still get my 10% return, I would like to. Okay. I've already run the numbers. So for sake of time, I'm just going to cut to the chase. You can build this with an 11 delta and still get about a 10% return. So I'm going to sell this 165 put, bing. And then I'm going to control click and I'm going to buy the 160 put. That'll create a $5 wide spread. And so I just control click on the ask. It adds it to the short put, creates a bull put spread order, and it runs all the numbers for you. It's great. It's 55 cents. I wanted at least 50. It's a $5 spread. And I'm getting an 11 delta. So you got almost a 90% chance of success, and you're making a 10% return, which is pretty good numbers. Pretty good numbers. So if I look at the chart, I say, well, how do I feel betting that Tesla stays above 165 for the next 30 days? Certainly, it's going to stay above that if the uptrend continues, right? It would have to break the 9, break the pivot low, break the 20, and then some to get to 165. That's about $60 out of the money. It's got a 12 delta, so I'm like 4 or 5 ATRs away. Gives me plenty of room there. So it seems like a pretty good trade. My only regret is that I didn't do this yesterday with you guys when it broke a prior day's high, right? I mean, you were buying the dip on Tesla. I think you should have done this yesterday. But you've got a good enough margin of error where maybe being off by 1 day doesn't make a world of difference, right? That's the ease of finding a trade with a credit spread versus buying stock. So I'm going to get into the management, the target, the stop loss. What do you do if you're wrong? I'm going to get into that in our YouTube webinar on Monday. You're getting an appetizer, a little taste to today in the Jedi options. But bull put spread, that's the intro. Great little strategy. Come join me on Monday evening for the whole enchilada here, the whole meal, and we'll dig more into how to manage these. But one of my favorite strategies, great way to learn how to sell premium on the options market.